What if I told you there's a trading system so powerful it helped its creator win the US investing championship with a staggering 155% annual return? That system is Mark Minervini's Volatility Contraction Pattern, or VCP, and today we're breaking down the golden rules that make it work.
Ow.
This isn't just about finding stocks, it's about building a fortress of discipline around your capital.
Ow.
So, if you're ready to transform your trading, grab a notepad, because these rules are pure gold. Let's start with the most important rule of all. Capital preservation comes first. Minervini says, if you still have capital, you still have opportunity. Think about that. Your money is your lifeblood in the market. Without it, you're out of the game. This means you should only risk a tiny fraction of your account on any single trade, ideally between 0.5% to 1%. See your losses not as failures, but as a business expense. Every successful business has costs, and in trading, small, controlled losses are the cost of finding those massive winners. This mindset immediately removes the pressure to be right on every trade and protects you from the catastrophic mistake of going Ellen. Rule number 2 is an extension of the first. Cut losses fast, no debate with the market.
Ow.
Minervini sets a hard stop-loss limit of 5 to 7% on every trade.
Ow.
No exceptions. If the price hits your stop, you exit immediately. You don't hesitate. You don't hope it will bounce back. And you certainly never, ever average down on a losing position. Averaging down is like throwing good money after bad. The market is telling you you're wrong. Your job is to listen, accept the small loss, and move on to the next opportunity. Stubbornness is the enemy of profitability. Now, what kind of stocks should you be trading? Rule 3 says to trade only true market leaders. We're not dumpster diving for cheap, beaten-down stocks here. We are hunting for the best of the best. These are companies with powerful earnings growth, consistent revenue expansion, and are top performers in the strongest sectors of the market. They are the stocks everyone is talking about for good reasons. You want to see institutions accumulating shares, not dumping them. Avoid companies with weak fundamentals, heavy debt, or low trading volume. You want to be in the fast lane with the strongest cars, not stuck in the slow lane with the clunkers. Next up, Rule 4. Trade only in the direction of the market trend. This is simple, but so many traders get it wrong. You never want to fight the overall market. Think of the market trend as a powerful river current. It's much easier to swim with it than against it. When the market is in a confirmed uptrend, that's when you get aggressive. But when the market is in a downtrend, you must shift into defensive mode. That means reducing your position sizes significantly, or, even better, moving to cash and waiting patiently on the sidelines. The market doesn't care about your opinion. Fighting the trend is a battle you will lose. So you've found a market leader in a strong uptrend. When do you buy? Rule 5 is critical. Buy only at the breakout, never inside the base. The VCP pattern is all about a stock consolidating, with volatility shrinking over time. This period of consolidation is called the base. Your job is not to guess where the bottom of the base is, or to buy in anticipation of a move. You wait for confirmation. The only time you enter is when the price breaks decisively above the high of the VCP structure, and this is key on strong volume. This volume confirmation tells you that large institutions are buying alongside you, validating the move. Patience here prevents you from getting chopped up in sideways action. Building on that, Rule 6 states that the closer you buy to the breakout, the lower the risk. The ideal entry point is right as the stock is emerging from its base. Minervini warns against chasing a stock that is already 10 to 15% extended above its breakout point. Why? Because stocks naturally pull back. If you buy too high, you're more likely to get shaken out on a normal, healthy pullback. A low-risk entry, close to the pivot point, gives you a tight stop-loss and a much better chance of surviving the initial volatility. This practice builds confidence, creates consistency, and is essential for long-term survival in the trading game. Let's talk about the math of profitability. Rule 7 is where it all comes together. Your winners must be much bigger than your losers. This is the secret to long-term success. You should only take trades where the potential reward is at least 3, 5, or even more times greater than your risk. Think about it. With a risk-reward ratio of 1 to 3, you can be wrong on 2 out of 3 trades and still break even. With a 1 to 5 ratio, one big winner can completely wipe out 5 or more small losses. This is how professional traders make their money, not by having a high win rate, but by having asymmetrical returns. Now, once you have a winning trade, what do? Rule 8 says to let your profits run, but cut losses without mercy. We've already covered cutting losses, but letting winners run is just as important and often harder emotionally. When a stock is moving in your favor, you need to have a plan to stay in the trade. A common technique is to use a trailing stop, moving your stop loss up as the stock makes new highs, locking in profits along the way. The biggest mistake amateur traders make is selling a strong stock too early, just because they're afraid of losing their paper profits. You have to treat your winners like a business owner protecting a valuable asset while cutting your losers like a robot with no emotion. Rule 9 addresses a common trading sign: overtrading. The rule is simple: fewer trades, higher quality. Your goal isn't to be busy, it's to be profitable. 1, 2, 3 high-quality setups that meet all your criteria are infinitely better than 10 impulsive emotional trades. Patience is a virtue in life, and it's a superpower in trading. Wait for that perfect VCP structure to form. Wait for the market to be in your favor. Wait for the volume confirmation. If the setup isn't a plus, you pass. Trading is a game of waiting, and those who wait for the best pitches hit the most home runs. So what's more important, being smart or being disciplined? Rule 10 gives us the answer: discipline beats intelligence. You can have a PhD in economics and still lose money in the market if you lack discipline. Your trading rules are your shield. It must never break them because of a news headline, a gut feeling, or an emotional impulse like fear or greed. The market is a battlefield of emotions. The traders who win over the long term are not necessarily the smartest, but the most disciplined. They follow their plan relentlessly, day in and day out. This leads us to Rule 11, a major paradigm shift for many traders. You don't need to win often. You need to win big. Forget about needing a 70 or 80% win rate. Minervini himself has a win rate of around 50%. How can he be so successful? Because his average gain is multiples of his average loss. He only needs to be right half the time, because when he's right, he makes a lot, and when he's wrong, he loses a little. The size of your wins and losses matters far more than the frequency. Focus on managing risk and capturing those outsized gains. Finally, all these rules are wrapped up in Mark Minervini's core mindset. He famously said, "I don't try to be right. I manage risk, and the market rewards me for it." This is the ultimate key. Trading is not about ego or proving you're right. It's a game of probabilities and risk management. By focusing on protecting your capital, cutting losses, and following a disciplined plan, you put the odds in your favor. You let the market do the work, and over time, it will reward you for your sound process. So there you have it, the golden rules of the VCP method. It's a comprehensive framework for risk management, stock selection, and execution. Mastering these rules takes time and practice, but they provide a clear roadmap to consistent profitability. Start implementing them one by one, and you'll see a profound difference in your trading results. Thanks for watching, and if you found this valuable, don't forget to like, subscribe, and hit that notification bell for more deep dives into winning trading strategies. Till next time, trade smart and trade safe.